Welcome to AM Best Audio.
The U.S. property and casualty insurance industry enters 2024 with strong momentum. Profitability was below insurers' cost of capital last year, but strong premium increases, easing claims cost inflation, and higher investment returns began to boost industry results by the second half of 2023. That's according to a recently released report from Swiss Re. I'm Lori Churtis for AM Best Audio, and I'm joined today by Thomas Holzheu. He's the chief economist for Swiss Re Americas. Thomas, welcome. It's great to speak with you again. Thank you so much for joining us.
Hello, Lori, and thanks for good to be back.
Thomas, your forecast for 2024 for the U.S. property and casualty insurance industry looks pretty strong. What's driving that optimism?
So the first reason is the fact that the US economy actually continues to be quite strong. If you look at the figures for the fourth quarter of last year, we see growth of 3.3%, and that's a stark contrast to a recession that was predicted by most economists just a year ago. Economic strength comes from consumer spending, private investment, and supporting demand in both personal lines and commercial lines for insurers. The second reason is progress on disinflation, and that improved quickly as supply chain pressures eased. And with the ongoing resilience in labor markets, the substantial slowdown in inflation has not really been matched by a slowdown in income growth, but we see a boost in productivity and real output. And that contributes to the third reason, which are higher interest rates compared to the pre-COVID years. And despite the predicted start of monetary easing in May this year, this is a positive development. So as a result, we have a forecast of a relatively strong economy, even with a slowdown in this year, disinflation and high interest rates compared to the pre-COVID years. And this is a benefit for insurers in terms of resilient demand, easing claims inflation, and rising investment yields.
So where do you see profits coming from this year? Underwriting, investment returns, or a bit of both?
Well, profitability was quite weak last year, but strong premium increases, easing claims inflation, and higher investment returns began to boost underwriting results. And particularly by the second half of last year, we expect these trends to continue in 24, supporting profitability from both sides. Personal lines are the driver of our improved underwriting outlook, with personal auto showing most of the improvement. Premium rates and premium increases in personal auto started to outpace claims costs in the third quarter of 23, and we expect this favorable momentum to continue through the year. At the same time, as personal lines improve, commercial lines are quite stable. So overall for the market, we see an improved underwriting result. And then on the investment side, we expect yields for the industry's fixed income portfolio to improve as reinvestment yields are above the maturing yields of the bond portfolios. This benefit is gradual, but significant. And the average maturity of insurer bond portfolio is around 6 to 7 years. So the rollover is gradual, but with a leverage of the investment portfolio of 2.5 times of the capital or equity, this is a significant boost. So it's a combination of underwriting and investment improving both.
Despite the optimism, do you think P&C insurers are still struggling with rate adequacy?
So overall, we find commercial lines rates to be slightly more adequate than personal lines, but these two segments have different momentum. Personal lines rates, they are accelerating, while loss costs growth is on a path of decelerating. This is mostly driven by personal auto, which is coming off a very poor 2-year period in terms of underwriting profitabilities. Homeowners rates are also improving, but they are not considered as adequate across the board. And we still see some insurers to slow writing new business in CAT-exposed areas and states. Commercial lines, on the other hand, they face the accelerating trend with regards to rate increases and a bit more persistent inflation coming from the economic inflation pressures in the areas that drive commercial lines claims cost, despite the fact that overall we see disinflation. Also, certain lines like cyber and D&O are seeing flat or negative rate increases, but this comes after very strong increases in the preceding 2 years. Additionally, I'd say the inflation pressures, they're shifted in nature and shifted from goods inflation to services, and this is more relevant for casualty lines and therefore for commercial lines. And so casualty lines are the pressure of inflation shifts from personal lines, where it has created a very negative impact for the last 2 years, towards casualty lines, more persistent, with healthcare and wage inflation being more sticky. And that's more of a claims driver on the liability lines. Commercial lines also continue to face pressures from social inflation. It's particularly relevant for liability lines and reserve risk, which is also exposed to both economic and social inflation. But these come with lags.
Customize your data experience. BestLink now offers an interactive company dashboard that provides company-level intelligence in a fast, user-friendly interface featuring interactive tables, charts, and Sparkline performance histories. Customize the dashboard tiles to prioritize the insurer ratings, data, and analytics that best support your workflow. AM Best. Our insight, your advantage.
You mentioned claims cost. Are those costs still a concern even as inflation is easing?
This inflation will be a big benefit to the insurance industry through providing relief in claims inflation. This benefit will come with a lag and will not play out evenly across business lines. If you look at the big picture, a commonly used proxy for inflation is core inflation. That's stripping out food and energy cost, and that was down to 3.9% increase in December. And so we see progress here. But if you look at specific lines and areas, inflation pressures had been much higher in certain areas, like, for example, cars, car repair, and construction cost. And that has led to a surge in claims cost for property and motor insurers in particular. If you look particularly at construction cost, they peaked at 23% in July 22, but have dropped now to less than 1% in December. And similarly, in terms of the development, but even stronger in terms of the magnitude, the index for used cars surged up by up to 45% in June 21, but then has turned around, and this has actually been negative now since November 22. So the business lines that were strongest hit by inflation shocks over the last 2 years, property and personal auto, they will also benefit the most from this inflation. By contrast, if you look at liability, they will less benefit from economic disinflation due to the different nature of claims. Healthcare and wage inflation, but also social inflation that will continue as a headwind for liability lines in particular. And social inflation is now getting more attention now again as the economic inflation winds down.
Thomas, what message should the insurance industry be taking away from this report?
So if underwriting remains disciplined and we don't face any of the major downside risk scenarios, then the current economic environment provides good opportunities for improved profitability for insurers. Despite the recent decline in interest rates, we expect that reinvestment yields remain above rates that on the maturing rates of the portfolios, and will remain higher than pre-COVID. And so we see for the next few years stronger investment returns, also supported by higher realized capital gains. Also in the longer term, we see interest rates, investment yields higher compared to the pre-COVID era, and this impact of a new interest rate regime on the insurance industry is profound. We get significantly higher returns on invested assets, but it also has pushed up cost of capital for the industry, which is now the highest in more than a decade. But we find that the benefit of higher rates for insurers through the investment returns outpace the increased cost of capital. And as a result, profitability will improve, and the profitability gap of the P&C industry will narrow, but probably not close in 24-25. So we see reduced claims inflation and gradually rising investment yields reinforce the view that the personal lines will have most tailwinds in this year and next.
Thomas, this has been so informative. It's always a pleasure. Thank you so much for taking the time to speak with us today.
Thank you for having me.
That was Thomas Holzheu, Chief Economist for Swiss Re Americas. For AM Best Audio, I'm Lori Chortis.
Looking to get the attention of the insurance industry? We have the platforms to do just that. Whether it be AM Best TV, AM Best Audio, Best Review Magazine, or Best Day. Find out more by contacting our Advertising Services Business Development Team at 908-882-1706.